Inflation came in lower than expected. The market celebrated. Disney earnings came in better than expected. The market celebrated. Is this a new secular bull market? The chart master Carter Braxton of Worth Charting and I will discuss tonight on Open Interest. Since the mid-June lows, the S&P has rallied almost 15%, quite a bounce. But today, the price action felt pretty weak to me as the day progressed. A buyer paid $2.3 million in premium on the September 23rd 3,800 puts. That was a purchase of 10,000 contracts. So Carter, what do you think is going on in the markets right now in the S&P, in rates, gold, risk assets generally?
Sure, let's try to tackle them all and each of them one at a time. But in terms of today's action, today was an extension, of course, of just the rally that's been underway since the June 17th low. As to the close, when you make important gains in any given session and then falter and close on the low, it has elements of exhaustion, is the term or phrase or word that would be used to describe today's behavior, which is to say the cumulative effect of a 7-week, it's almost 7-week advance to a difficult level, up some 14+%, leaves the market vulnerable to selling pressure. Two types: people who bought well, dumb luck or brilliance down at the lows, looking to book those gains. I've made 14 or I've made 20 in this stock. And also people from above who were hurt by the sell-off, who now have had losses recouped and money returned to them. So you'll see here on the chart, we've actually recouped exactly one half of the sell-off from the Jan 4 high, June 16 low, and we're literally at the dead middle. And we got a little above the midpoint, a Fibonacci retracement for those who traffic in that kind of thing, and we stopped dead cold. If you look at the second chart, and this is not random, we also stopped dead cold at the 150-day moving average, went a little above it, and then faltered. So if we put charts 1 and 2 together, you'll see what an important level this is and how truly the market hit its head. And my hunch is we do a lot of backing and filling or backing away from this level rather than just pushing higher.
So that brings me to another question, which is I think a lot of the enthusiasm that we saw, and certainly the enthusiasm that we saw on Wednesday, was a function of rates. And the trade that I saw in TLT, which is the ETF that tracks the rate picture, was a purchase in good size of the 1x2 call spread. Now this one, actually they were shorting the 128 strike call. So what that suggests, a person who does that trade is expecting that TLT could rally a bit further, which is another way of saying, for example, that the 10-year rate could actually come in further from the level where we are now, but that it might not get substantially below the levels that we saw in early April. And just to remind people where we were in early April, that was with 10-year rates at around 2.5%. How does that bet align with what you're seeing?
Well, I mean, they're one and the same. Not, let's say it this way. We know that in principle, right, that equities are valued on two things: some risk-free rate of return tied to treasury yields, but also to an earnings growth and putting a multiple on it. And the market participants have generally said, hey, because yields have dropped from 3.5 to 2.5, we can then go back to the business or nonsense of putting any multiple we want on any stock, right? And so the question is, and this gets to the real insanity of it, to be frank, the cost of 10-year money at 3.5% versus 2.5% makes no difference. It's when it's 6 and 7 that it should make a difference. But yet the world moves stocks around violently because of this kind of thing. It's 100 basis points, yes, and on a percentage basis, it's a lot. But it shouldn't really matter if someone is doing what they're, quote, supposed to be doing, which is 3 to 5 year cash flow, projected cash flow analysis, and assigning a value to it. There's no difference, 275 255 and 325.
Yeah, I mean, I think one of the reasons that you begin to see such violent swings when rates are low has to do with convexity of risk assets and also where most of the froth was. So as rates decline, convexity increases, which means that the sensitivity of a risk asset's price to changes in rates, all else equal, is higher when rates are lower. But also much of the froth that we saw was in the most speculative types of stocks that weren't even necessarily making money. I'm talking about the Cathie Woods types of names, the things that aren't making any money now aren't likely to make money in the very near future. So people are discounting cash flows that aren't 1, 2 to 5 years out. They're making projections based on the theory that maybe someday they're profitable 10 years out. And that's going to have a lot of duration. It's going to be very sensitive to rates. But what is also sensitive to rates are things like the dollar and, of course, gold. And as rates went higher, that obviously normally puts pressure on gold because it gives people some faith that the Fed is going to try to strengthen the dollar. But the trade that stuck out to me that I saw in GLD, which is the ETF that tracks gold, was actually a sale of the 175.82 call spread. Now, selling a call spread, we usually call that a bear call spread. That's not hugely bearish on gold. That's not outright buying puts or shorting the futures. But it is saying it's probably going to run into some resistance here, may trend sideways, or may drift a little bit lower. Is that in alignment with what you're seeing too?
Very much so. And I think you'll see here on the chart of gold that gold and the dollar, of course, the reciprocal one another, but the dollar has sold off. It's in fact it's only a 4.2% decline from the peak, but that's the largest decline of the past 18 months. And we've broken trend. I'm in the camp the dollar goes lower. And of course, the reciprocal of this, right, if you'll see on gold, is that gold has rallied. But gold has rallied to a difficult level. And then there's also, just before we go back to gold and look at this chart in detail, these relationships, not spurious, but they're tentative and mercurial. For instance, wait a minute, the dollar's collapsing, then oil should be ripping, but it's not. It's going exactly the opposite. So sometimes there's a correlation, sometimes there's not. Right now, yes, dollar coming off, gold is advancing, but gold has advanced a lot, and as you can see here in the chart, right to the penny to a well-defined downtrend line.
Yeah, I mean, of course, oil has its own things going on. They often will say the best cure for inflation is inflation. Now, if you raise gas prices enough, sooner or later people are going to change their behavior. They're going to consume less of it. Add to that, we had the SPR release, and a good percentage of that SPR release has already taken place. And the price of these types of commodities is largely going to be dictated at the margins for supply and demand. So you might think a 1 million barrel release from the SPR isn't that meaningful, but on the margins it can be very, very meaningful. I mean, your take, and then I'll share mine, but to those who have asked the question, and I think many people have been asking me recently, is this bounce that we've seen a new secular bull market? What's your answer to that?
Yeah, no. I mean, in many ways, the words force a thought or a judgment that doesn't have to be made. So, are we, let's say, are you, when would ask you about your health or your career or your primary relationship, are you prospering? Is it going well or isn't it? Meaning, there are periods where things are generally doing well, and there are periods where they're called setbacks. And so, secular cyclical is always a big thing, bear or bull. But what we do know is we've had a very aggressive bounce off of the COVID low, and we've had a multi-year advance since the 2009 low. And while we've had setbacks, COVID being the most pronounced, it was quickly righted, whether one believes artificially or not, from the government. And we have gone not only from those lows back to the pre-COVID level, but to great heights that many people would say exceeded the valuation seen in the dot-com era and other things. And so this sell-off that we've seen since, it's perfectly normal. After all, the etymology of the word correction, it implies that something was incorrect. It was too far, too fast. So the give back is normal, the bounce is normal, and now we're the truth is we're this is the ultimate pair of twos. The market's maybe where it belongs. Oil's been re-rated from 130 a barrel to 88. Dollar's been re-rated lower. Gold's been re-rated higher. Equities have sold off and now bounced. Everything's maybe sort of, after all the news is done, Fed, earnings, and now we have to wait and watch.
Yeah, this actually happens to align pretty closely to my own view from a fundamental standpoint. And basically my rationale is this. Last Friday, we got a way better than expected jobs number, over 500,000 new jobs. And then we got better than expected inflation data on Wednesday. Now, the jobs data, a lot of people said at the time that they'd wished the number had come in a little bit softer because they believed that would be a mediating factor for the Fed's action. I actually took the other side of that because the worst possible economic circumstance you could have is high inflation plus a lot of signs that the economy is weakening badly. This is, of course, what Paul Volcker had to deal with. He had a moribund economy and very high rates of inflation, and yet he had to force rates considerably higher. The best circumstance when you're faced with inflation is an otherwise healthy economy. And to me, that's what we have. These two forces are trying to offset each other. That's probably going to leave us relatively range-bound, in my view, as we work our way out of it. Carter, thank you so much for joining us. Thank all of you for watching. Hit the like button, subscribe, send us some comments or questions, and we'll try to answer them.